Good morning and welcome to the Shenkman Wealth Management Accountant Attorney Winter Webinar Series. This program is entitled 10 Practical but Overlooked Pointers When Doing Estate Planning. For those who don't know me, my name is Jonathan Shenkman. I'm the president of Shenkman Wealth Management. In that role, I work as a financial advisor, portfolio manager, and serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focused on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, Bloomberg, CNBC, Fortune, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, U.S. News and World Report, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. Today, we're privileged to hear from Kestenbaum, partner and co-chair of the Trust and Estates Practice Group at Meltzer, Lippe, based on Long Island, New York. Avi provides creative and sophisticated domestic and international tax, estate planning, and asset preservation counsel to CEOs of major corporations, ultra high net worth individuals, multinational businesses, and large charitable organizations. He has also successfully represented many clients, including individuals, trusts and estates, businesses, and charitable organizations with IRS and state tax audits. His practice places special emphasis on domestic and international tax and trust planning, big picture philosophy, family business succession planning, and effectively dealing with estate disputes. Avi has also published dozens of articles in leading national tax, estate planning, and tax-exempt organization publications, including, among others, Estate Planning Journal, Trust and Estates, Limeberg's newsletter, Practical Tax Strategies, Journal of Taxation of Exempts, and the New York Law Journal Special Trust and Estate sections, and is a prominent national lecturer. Today, Avi will be speaking on 10 practical but overlooked pointers when doing estate planning. And with that introduction, I'll now turn the program over to Avi.
Thank you, Jonathan. It's nice to be presenting. I appreciate the opportunity, and thank you to everyone. I know the end of the year is often a very hectic time, so thank you for giving me a few minutes. As I'm looking at my screen, I notice how cluttered my office is, so you'll have to excuse me. It's that time of the year. In any event, so some of these topics, because I'm just running through 10 practical points, I'm going to run through quickly. Some of them I'm going to spend a little bit more time, but here we go, and we're going to speak quickly and try to get through these. There is a major hole in the estate planning field, and that's with partnership agreements, company agreements, and succession planning, a really complex area. But for many individuals, they either have not looked at their partnership agreements, don't have the agreements, haven't put a lot of thought into them for a variety of reasons. This applies both to family businesses and non-family businesses. From an attorney's perspective, I think one of the reasons there's a gap and a major hole here is that this encompasses three major practice areas. We've got the tax area, because we're dealing with partnership tax, sometimes corporate tax. We're dealing with estate planning, how these interests pass, estate issues, estate tax issues. And then we're dealing with general business agreements, where a corporate attorney would be drafting the agreements. And the problem is, each one of these three has a particular role, and typically none of them can do it all themselves, or certainly not recognize all the issues. And if you looked at the statistics, most businesses fail and partnerships break up, not because of the tax issues, but because of disputes and infighting. Again, sometimes family, sometimes non-family. And the statistics are sobering. Happy to share that with all of you. Basically, all partnerships eventually break up. Either they break up because there's a dispute, or somebody dies, or there's a disability. And there's so little emphasis on this, and there's so little in my opinion, expertise onto how to properly draft these agreements. I'm just going to give you one thought today. Obviously, this is complicated, but just one thought To me, that's very important. If somebody wants out, you got to give them the opportunity to get out. And you're towing the line between letting the business continue. The business has got to continue to remain strong, but the person's got to be able to get out in a fair or reasonable way, or else they're going to sue, or else they're going to be upset. Families will break up. Longtime friends will no longer speak with each other. And that's the job at the time of the creation of the business, or shortly thereafter, where the parent can do it, because the parent is basically running it, not leaving it to the children to do this, or in the non-family setting at the outset. Yes, it can also be done 5 or 10 years later, or even later or longer in the future, but typically it's best addressed right away. Here's the concept. You've got to let somebody get out, and you can set the price or the amount in the agreement. So you can set that amount. Maybe there's an appraisal process. Maybe it's paid over 10 years of time. But parents and also non-parents who are setting these agreements, who want to make them ultra restrictive, not let people out, or cause irreparable harm or damage because somebody feels that they cannot get out, it's not worth it. A parent's greatest wish is typically their children work together, stay together, and it's not just a business. It could be a piece of real estate. Well, that's terrific, and that's great in theory. It doesn't work long term, and there's a reason why most businesses do not last past the first or second generation. So be careful with those provisions. Don't make it overly restrictive. Yes, you got to make it that the business can continue. Maybe there's a payout over a number of years, but just don't make these agreements too restrictive. You cannot, as they say, fit an elephant into a needle. And sometimes it's not good to force people to work together, even if it's not a business. It could be a piece of real estate. And again, this is why most businesses will fail after a generation or two. And even, again, non-family businesses, you've got to be very careful with these agreements as well. Okay, in a similar vein, very often we see children and parent lumped in a trust together, whether it's your classic SLAT, spousal lifetime access trust, whether it's the credit shelter trust in the will. Typically, I'll use myself as an example. If I pass away, perhaps I will leave my wife and children in a trust together. They can both eat out of the same trust. Oftentimes, we do this with younger couples, older couples. Assets are left in some type of trust, and the beneficiaries of the trust are both the surviving parent and also the children. Now, in theory, it sounds great because, the children, they know it's really the mom's money. They know it really doesn't belong to them and she comes first. But in practice, it's not actually how it works. Take an example. I have a real life situation. It's a client who came to me later in life, but a woman whose husband died at a young age. He left the assets in a trust for protection purposes for the benefit of his wife and the children. Children are now grown up now. What's going on now is every time mom takes out money, the children say, "Mom, you're taking money from the trust. We're beneficiaries too." And mom says, "What do you mean? If your father was still alive, this would be my money and his money. It wouldn't be your money." So when you're doing the estate planning, I'm not saying that in the SLAT and in the documents you're doing that there cannot be a trust for the benefit of both the spouse and the children. But it's a good idea, in my opinion, to separate some of the assets. Maybe there's a life insurance policy just for the kids. Maybe there's a life insurance policy just for the wife. Maybe some assets are just for the kids or just for the surviving widow. But again, you don't need to lump them together in everything. You will make them natural enemies. Obviously, in second marriages or third marriages or fourth marriages, you certainly don't want to have a step parent in eating out of the same assets as the natural children. That we all know. But even in a situation where the natural parent, you will sometimes make parents or a surviving parent and his or her children enemies of each other. I have not heard this from anyone else. Most people put them all together, no problem, because mom will be the trustee, mom will be in charge. But again, the children see that trust later on. They see they're lumped together in the same document. They will feel it's their assets. And again, some people will say it's primarily for the benefit of mom before the kids. But again, in my opinion, it could create problems. Think long and hard and consider separating a certain amount of assets. And of course, if there's a trust just for the kids, mom benefits too, because then mom doesn't have to worry about supporting the kids because there are separate assets for them. That's point number two. Point number three, on another note, but a similar note, very often in the documents, we leave assets outright to spouse, right? I pass away, I leave my assets to my spouse, or vice versa. That's all good, but what we need to understand is there is a major phenomenon today, and that is people are getting remarried, even in very healthy, happy marriages. Husband or wife dies in their 70s. There's a remarriage of the spouse a few years later, could even be in their 80s. And I see this all the time. Another example, a woman who I know came to me for advice. Her father died when her mother was in her 60s. The father ends up getting remarried, is married to his second wife for 20 years. Everything's fine. There are no problems. Again, we're not dealing with anything nefarious. However, she knows the father is planning on leaving assets to stepmom and also to her adult kids. And the daughter is obviously livid. What do you mean? And I said to the daughter, well, what do you mean? Why shouldn't this man leave assets to his second wife? I understand, your mom was his wife for 40 years or whatever, but he's married to this woman for 20 years. She's taking care of him. He's older. So, it's interesting how everyone sees things from their own vantage point. I always give the Little League example. When I used to go to Little League game for my kids, it's interesting how when the ball is like on the line between fair or foul, if I want the ball to be fair, because that helps my son, I see it as fair. If I want it to be foul, I see it as foul. And it's like this with every single parent. And it's not like we're trying to help our kids or skirt the truth. That's how we see it. When we want to see something a certain way, that's how we see it. And, that's how it is in estate planning also. This fairness of how assets are divided, legitimately, people see it their way. So the responses to this is, and again, there are no perfect solutions. This is complex, but thought has to be put into it. And when you're drafting documents, even for young couples, again, have some assets maybe separated just for the kids in trust. So this is less of an issue. And maybe what goes to the spouse, have it in a marital trust. The advantage of the marital trust is then it passes to the kids. It does not go to the next spouse, the next family. Again, it's not an all or a nothing. You've got to figure out how to make everyone happy. And again, the next spouse obviously should get assets. It's not about not leaving them anything. Obviously, prenuptial agreements help. A lot of times people don't do prenuptial agreements. They're not done correctly. A lot of issues with prenuptial agreements, but thought has to be put in at the outset of the planning. There is nothing cookie cutter about estate planning. I'm going to jump to another point, even though it's at the end. I had a great uncle of blessed memory who would say, there are two people who I don't skimp on hiring the best. One is lawyers, the other is doctors. I would add a lot of other professionals too, including accountants and financial advisors. But the bottom line is, it's worth it to get proper advice. You're talking about your assets, your families, your wife, your kids. Go to somebody good. It doesn't mean they need to be at a major law firm, but it does mean that they have to know what they're doing. And there's nothing here that's cookie cutter. There's both tax and call it a higher level advice when dealing with family situations. Back to the business setting. Very often for buyouts, people have life insurance. So, for example, I own a life insurance policy on my partner. When he dies, I take the money that I have on his life and I use it to buy out his share of the business, right? Common buy-sell agreement using life insurance. Sometimes the company owns a life insurance. There's a redemption. This is another area which falls between the cracks because you have tax issues, estate planning issues, and drafting agreements. And in my opinion, very few people know how to handle this correctly. So I want to give you a concept that my partner and mentor, Joe Katz, taught me many years ago. At the end of the day, it's about economics, getting the deceased family the right amount of money, whatever that amount is. So in the situation where I have to buy him out, what you're doing is for death tax purposes, that value, that's in his estate. So you may be creating a death tax issue by setting a value in the agreement using life insurance. Besides the fact, it's kind of a pain, it's cumbersome. You're now, the family requires me taking it and buying it from them. Wouldn't it be much easier if the family had their own life insurance, held in a life insurance trust, exempt from death taxes, and instead we set a low buy sell amount in the agreement, and again it's paid over 10 years. What that does is the business continues, the business can afford to pay it out, the family gets the same amount of money because again it's purely in economics and they control it. It's in a life insurance trust that they own. So why do we need to do this through a buy sell agreement, which could create A, estate tax issues, B, requires the partner to do something? Literally, if the family has their own life insurance, maybe the company has paid for in a life insurance trust, they don't need to ask anyone for anything. They've got their big chunk of money. The buy sell could be set at a lower price, which lowers the value for estate tax purposes. Now, some of you on the phone will say, well, that doesn't really lower the value just because you set a low value. And the answer is, typically it does between unrelated partners. Typically it does. The IRS will respect that. I understand between related partners, the IRS will not respect it enough, but at least understand the concept. It's about economics. It's not, hey, we got to buy this out at its value. No, we got to get the family the value. It doesn't matter where we get it from. And if we could get it to them in an easier manner, in a tax-free manner, why not? I literally have not heard this from anyone except for Joe Katz. It is brilliant if you think about it. If anyone wants me to explain this to them again, happy to speak with you after January and the craziness ends. But it's a really great concept. Similarly, on that note, regarding partnership agreements, the important provisions, I pointed out one, being able to let people out so they don't feel trapped, yet the business being able to continue. There are like 5 or 6 other major points: transferability, management control. If somebody's not working hard, do they still get paid? I mean, there are a whole host of issues that destroy these agreements. And again, some of them are tax, some of them are estate planning, some of them have to deal with just understanding why partnerships break up. But again, happy to have a longer conversation after January if I haven't run away for a few months to rest. Okay, let me turn to another topic. I only got about 15 minutes left. Trustees. People say, who do I hire as trustees? Who do I hire as executors? So just a few quick points here. Number one, sibling trustees typically aren't great. Nobody wants their sibling to tell them when they get funds or how they get funds. I understand it's not perfect, meaning there are situations where a sibling does need to be a trustee. Maybe you have a disabled beneficiary, maybe you have one where it's not going to create issues, but typically don't make one sibling the boss of the other. I always tell this, it's true. The first 2 siblings that are recorded in the Bible, what happened? One kid killed the other. First murder, 2 siblings, fratricide. Don't make children enemies, or one boss over the other. Another point, which I learned from an old boss of mine who was not nice to me, but I will take this nice point that he taught me. Try to have an odd number if possible. If you have 2 or 4 executors or trustees are the possibilities, what if they disagree? Now they're stuck. So either have an odd number, or if you have an even number, have a tiebreaker provision. Have somebody who can break that tie. That will avoid delays, fights, and it's so easy. I mean, literally, just have a tiebreaker. If there's a disagreement or a stalemate, be careful having even numbers. I'm not saying, nothing that I'm saying is always true or never true, but just understand the concept. Tiebreaker provision if there's a disagreement, and so try to have an odd number if possible. Fees and commissions. People say to me, my trustee executor, I don't want to pay them anything. Well, what do you mean you don't want to pay them anything? It's a lot of work. It's a job. If you want your executors and trustees to really do the right thing and help your family, you have to pay them. Now, I understand if the trustee or the executor is a beneficiary and is already getting money, okay. But if they're doing a job for somebody else, either for a sibling or it's an independent person, the general rule in life, you get what you pay for, and it's a lot of work. And it's not fair. And people, they have all these limiting provisions. I'm not saying they should get the statutory commission, right? The statutory commission could be 1%, could be 2%, could be more. I get it. But don't say, they don't need anything. They're doing me a favor. It's too many hours of work. There's too much liability. You want to get somebody who's going to do the right thing, pay them. If they choose not to accept it, great. But do the right thing. If you want to get the person to really do the job and not regret it later. On the topic of executors or trustees, people ask me, well, who's a good person? Another important point, you don't need a genius. You don't need somebody who's financially extremely savvy. Sometimes if you pick that person, you get the opposite result. They think they're so smart, they invest the money foolishly and lose it. I would much rather have somebody who is trustworthy and they speak to the right person, right? When you're a trustee, you need to speak to the lawyer, to the accountant, to the investment advisor. Have somebody trustworthy who knows who to speak with. You don't need a genius. Oftentimes geniuses, they think their way is the best and the better way. So that's not something that you need to do. In fact, sometimes that has the opposite effect. Okay, back to an income tax and an estate tax pointer. I think we're up to number 6. You see a lot of people creating these SLATs, these spousal lifetime access trusts. So I use my exemption, I create a trust, it's for the benefit of my wife and kids. My wife does the same. She puts assets in a trust, it's for me and the kids. At the end of the day, we get the assets out of our estate, we use our exemptions, but I'm a permissible beneficiary of one trust, she's a permissible beneficiary of another trust, and we still have access to all the assets, sometimes called a spousal lifetime access trust or a SLAT. By the way, I hate this acronym because there's no internal revenue code called a SLAT or provision. It's a marketing term. It makes it sound like, I don't know, like we're selling ice cream or some technology, but we'll go with SLAT. That's the term that's used. Okay, suppose I want a distribution. I need money from that SLAT. Or suppose I need money to pay the income taxes. Typically, SLATs are grantor trusts. I need to pay the income taxes. An idea. Instead of my getting a distribution from the trust, or instead of my being reimbursed for income taxes as a trust typically allows by an independent person, which the IRS said was okay, why don't I just borrow money from the trust? And you can hopefully understand right away why that's a much better result. If I just get money from the trust, either as a reimbursement for income taxes or as a distribution, I've just taken money that's estate tax free out of the trust, and I've basically taken it and added it to my estate. I understand I'm going to spend it, but I've depleted the trust. Wouldn't it make a lot more sense if I borrowed money from the trust? It's a grantor trust, pay the AFR interest, and it's not taxable, that interest payment, because it's between me and my grantor trust. And when I die, at worst case, I still have a few million of assets, let's say, but I owe money to my trust, and that will offset the assets in my estate. So why should I take a distribution? I'd be much better off borrowing. A, it doesn't deplete the trust. B, that's an offset in my estate. It reduces my overall estate. And again, what's the big deal about borrowing? I pay back the trust for my wife and kids or for my kids. No income tax. It acts as an offset to the assets that are in my estate. Why take a distribution? Why take a reimbursement? Okay, moving right along. I know I'm running out of time already. We typically have 3 well-known estate freezes, planning to get appreciation out of the estate. Some of you may get this, some of you may not. It's okay. We've got the grantor retained annuity trust, We have the sale to the grantor trust. I don't say defective grantor trust. There's nothing defective about it. It's another marketing term. It's just a sale to a grantor trust. And we have the freeze partnership. Okay, these are three bread and butter techniques. Be careful which technique you use. I know a lot of very conservative firms push the GRAT. The GRAT is not effective for generation skipping tax purposes. And for dealing with serious wealth, why would I do a GRAT? The sale to the grantor trust has been blessed. There's never been a problem with it that we're aware of from the IRS saying it doesn't work. We've got quandary clauses and other types of clauses that could deal if there's a valuation adjustment. I know the GRAT is statutory, but the sale to the grantor trust is so much better just for the generation skipping tax of being able to do that alone. Why do a GRAT? And again, maybe there are situations where we're so concerned about value. And then when you're dealing with real estate, why wouldn't you do a freeze partnership where you, because the grantor, the father, or the owner is retaining an interest in the partnership, we can extinguish negative basis or negative capital if there is in the real estate. And number two, we can get 6166. The estate tax can be paid over 15 years. So why wouldn't you do that? And again, for another discussion, but be careful which freeze that you take. There's actually a big difference between them. And anyone who only does GRATs, I would say, I don't understand why you would do that. Anyone who would do, only sales and not freezes. So keep that in mind. Age distributions. The older documents that you see very often have distributions coming out, a third at 30, a third at 35, a third at 40. I think modern day estate planning, and this, I'm not telling you anything you haven't heard, says don't do that. Just make the child trustee over his own trust, a portion at those ages. The child can appoint anyone he wants as his or her co-trustee, could have certain higher fire powers of over the co-trustee. So you have the best of all worlds. The assets are protected. They're out of the child's estate. When I mean protected, they're protected from creditors, protected from divorce. The child has control over them out of his estate, and no one can take it away from him. So why would you ever have outright distributions? You can get to the same place by just making the child trustee with powers over a co-trustee, or just being his own trustee, doesn't need a co-trustee unless he or she wants a distribution. I think modern day planners all do this, but you still see older documents that have this. Sometimes we decant. We have older trusts that have this. Let's decant. Why force assets out of a trust? And again, when you make the child trustee or co-trustee at a certain age, the child could find a way to get the assets out. So you're giving him flexibility. He wants to take it out, great, but if he leaves it in, he's fully protected. Why ever force it out? Never made any sense. Again, this is not just my point. I think this is something that's well known now. Okay, 5 more minutes. A lot of wealthy people give money to foundations, specifically at the end of the year. Terrific, great, foundations are wonderful. Okay, if you're giving a lot of money to a foundation, why not couple that with a CLAT, a charitable lead annuity trust? The concept of a CLAT is if you put money in the CLAT, it gives money every single year for a term of years or the lifetime of the donor to charity. So if the CLAT is 15 years, every year for 15 years could give money to the foundation, to the client's own foundation. The foundation is still getting the money. At the end of the 15 years, if the CLAT has beat the 75-20 rate, which typically most investments will beat, and again, now the 75-20 rate's a little higher, the family will actually get something back. So again, if the trust is a little complicated, but if the trust is set up as a grantor CLAT, same deduction, but if the CLAT, which is subject to the private foundation investment rules, beats the hurdle rate, which again is pretty easy to do over a long period of time, same charitable deduction, money's going into the foundation, and the family can actually get something back in the end. To me, it's a no-brainer if somebody wants something maybe going back to his family. Why not anytime a client either puts a large amount of money into a foundation or is looking to give charity but maybe wants to keep something, consider the coupling the CLAT with the foundation. Beware of charlatans. More and more today, I'm hearing tax practitioners with very sketchy backgrounds, marketing techniques. And if they sound too good to be true, they probably are. A big one that's marketed now is stick the business in an offshore private placement life insurance policy and have it sold, and you won't pay any US income taxes. Big one today. Well, there are a lot of rules with that. A, there are rules getting the policy in, maybe gift tax issues, income tax issues. B, once you put it in, you cannot have any more say whatsoever with that business or that asset under the investor control rules. And typically the people who are marketing these, again, just in my opinion, I don't want to say most of them, many of them are peddling this as a tax shelter, as a tax scheme. They have sketchy backgrounds. I'm not saying there isn't some possibility this could work. Like every technique, it sometimes works and there's some truth to it. And, I think what charlatans do is they take something that has some semblance of truth and then they morph it into something which doesn't work. So something's too good to be true. Be careful. Speak to a qualified tax attorney or trust and estates attorney from a qualified firm. Check out the backgrounds of the people you work with. People are so quick. Oh my God, that sounds amazing. Oh my God, no one's ever been audited. I mean, just be smart about it. Don't get yourself into trouble. And by the way, if any of these promoters get in trouble, anyone on their list is going to get in trouble. And I've spoken to IRS auditors. They basically tell me once we've got somebody peddling things, we will get the list and we will find out everyone who they're dealing with. There's some others involving charities and impermissible transactions with charitable organizations. It's not worth it. Final point. A lot of people have assets in different jurisdictions. Could just be a vacation home in another country. For that matter, it could be in a different state. You've got homes in New York and Florida, a bungalow in the Catskills, different, or maybe in different countries, you also have assets in those other countries. Forgetting about the tax issues, which are too complicated for a 2-minute drill, as they would say on ESPN. Probate. When you have to take the U.S. will, get it apostilled, then sent to the other country, get it admitted, having them understand and dealing with the asset, extremely expensive, extremely time consuming. So either you have a will in multiple countries that will save you a ton of time and aggravation. And anyone, again, who owns an apartment in a different country or a house, please listen to this. You generally should have a separate will in that country, or if you're in a different state in the United States, have the property in a revocable trust. I think people are realizing, especially during COVID, when the courts were completely backed up, but even not in COVID, utilizing revocable trusts, forgetting about for tax planning purposes, revocable trusts don't help for that, just avoiding unnecessary delays in the estate administration, red tape. And if you have assets in other countries, sometimes you could use revocable trust there as well, and you would avoid probate in those countries. Not all countries are going to allow the deed to say the revocable trust, but at least deal with it, have a separate will in that country. And again, every situation is different, but again, don't make it difficult on your children, on the next generation, on your spouse. When you've got assets in different countries, of course, get tax advice as well. But more and more clients that I have assets all over the place. They need to be smart. Of course, by the way, foreigners, who I don't know if you have as clients or are on this call, foreigners also have US death tax issues. So a lot of people are shocked. Somebody lives in another country, no connection to the US. Certain assets they own are subject to U.S. death taxes with a very limited exemption. So, for example, shares of U.S. securities subject to U.S. stock. So my client in South America or Israel owns IBM, Apple, Google. They're literally subject to U.S. death taxes on that. They don't realize it, certainly if they own U.S. real estate. So again, just be mindful of this. And also, like I said, the probate issues. My time was up a minute and a half ago. I understand on each of these topics, I could have spent the half an hour, but hopefully these are some pointers that you can take home with you, and maybe some of them you haven't heard before. Thank you again, Jonathan, for the opportunity to present.
Great. Thank you so much, Avi. As always, if anybody has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to Avi or myself where appropriate. And I'll be sure to include his contact information in the follow-up email tomorrow morning to this program. As I
Although
mentioned,
I should just say, end of the year is absolutely wackadoodle. So there may be a little bit of a delay unless it's an emergency, but I very much appreciate that, Jonathan.
save Avi's email and email him after the 1st of January.
Okay.
As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management topics and to collaborate where appropriate. And I think we can all agree that clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Just 3 more quick items before I let you go. First, my winter webinar series continues on Tuesday, January 3rd, featuring Elizabeth Forspan, co-managing partner at Forspan Clear, based in Long Island, New York. She'll be speaking on the intersection of elder care planning and estate tax planning, where the Medicaid and estate planning meet and diverge. I'll send out an invitation to this and all of my upcoming webinars after the program. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. Finally, if you or a colleague would like to be kept abreast of my latest articles, webinars, and all the other work I put out, you can sign up for my free monthly newsletter. Simply email me with the word newsletter in the subject line. You can also follow me on Twitter, YouTube, and Instagram. My handle is @ShenkmanOnMoney. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.